Okay, you are welcome to First Big Forex Academy. If this is your first time of visiting our channel, kindly subscribe and turn on the notification button so that you would always get notified whenever we drop a new video. So today, I will be taking you through the basics of Forex. Now we are starting with what is Forex? This is a very, very important question that needs to be answered. Now, what is Forex? Forex trading is the buying and selling of one currency for another in the global foreign exchange market to make profits. The buying and selling of one currency for another in the global foreign exchange market. What it means is that Forex trading is all about buying one country's currency and selling another country's currency. And this action happens simultaneously. It happens at the same time. Now, somebody might be tempted to ask, what is traded in Forex? What is traded in Forex? Well, the simple answer is money. This money can be in the form of currencies, metals like gold, silver, oil, stocks, futures, and cryptocurrencies. All of these things, one name for them is what? Money. So money is traded in the Forex market. Everything that is traded in the Forex market can be classified under what? Money. Who are Forex market participants? Who are the people that participate in the Forex market? The major market participants include: one, the government. Every country has trade ally with other countries, e.g., China buys American soya, sells electronics. When they do this, currencies are exchanged. China will have to sell their yuan to buy dollar in order to purchase American soya, while Africans have to convert their currencies to dollar in order to pay China for their electronics. Now, it is very, very important for us to understand that every country's government is involved in the forex market. When a particular country does business with another country, that is forex trading, because one country would need to convert their currency to the other country's currency. There has to be interconversion of currencies for this to be possible. Now, the second category of people that participate in the forex market is the central bank. Every country has central bank. Here in Nigeria, we have a central bank, which is called CBN, Central Bank of Nigeria. Now, governments and central banks, such as the Bank of Japan, the Bank of England, and the Federal Reserve, are regularly involved in the forex market. The third category of people who participate in the forex market include what we call the commercial traders. These guys are the big boys. They include the big financial institutions, such as the banks, financial servicing companies, etc. Examples, we have the Chase, Barclays, and all of them. So they come to the market with a lot of money, billions of dollars. Their decision on what currency to buy or sell can make the market move considerably. These are the big boys. They trade the market with billions of dollars. These are financial institutions, big banks, okay? They're called commercial traders, large institutions. And of course, we have the last category of people that trade the financial market or the forex market. They are called the retail traders. This includes you and I. We are individuals trying to take advantage of this flow all around the world. Cash flow. Now, in the forex market, we are concerned about where money would be going next. That is what we are concerned about in the forex market. Cash flow, where money would be going to next. Is money going to fall, or is money going to gain value? Okay, is the direction of money going to be upwards or downwards? In fact, everything we do in forex trading is trying to predict price movements. Okay, it's trying to predict the movement of money, which is price movements, and we can do this with fundamental analysis, technical analysis. Okay, now let's talk about forex trading sessions. There are various trading times and trading sessions in forex. Now, let me explain this. Now, all over the world, trading sessions have been categorized based on regions in the world, based on zones in the world that share common time, common time, yes, that share common time. That's how they've classified it. For instance, we have the Sydney session, we have Tokyo session, London session, Frankfurt session, we have the New York session. Now, let's talk about the Sydney session. Of course, Sydney is the capital city of Australia, right? Now, of course, we know that Australia represents a continent on its own. Now, all the regions that fall within this Australian, this Australian region, they are classified into the Sydney session. Their forex trading session is classified as Sydney session. Then we have the Tokyo session. Tokyo is the capital city of Japan. Japan represents the Asian section. All the countries that fall into this Asian section are classified as Tokyo session. So their trading session is what we call Tokyo session. We have the London session. London is the capital city of England. It represents the United Kingdom. All the regions that make up the United Kingdom fall under what we call the London session, right? Of course, we are talking about Scotland, Wales. We are talking about England. All these countries that make up the UK, they fall into what we call the London session. The Frankfurt session. Frankfurt is the business and financial center of Germany. Okay, it represents the Europe because Germany is located in Europe. Okay, so all the regions that fall into this European Union, they belong to what we call the Frankfurt session. So their trading session is what we call the Frankfurt session. And finally, we have the New York session. The New York session. New York City is a commercial hub of the United States of America, right? Now, all the American regions fall into this New York session. The session's names are derived from the major cities in which most of the transactions are done. Now, since we have different trading sessions, let's talk about their trading times. What time do they open and what time do they close? We have listed 5 different trading sessions, 5 different forex trading sessions. Now, let's talk about their trading times. Sydney sessions opens by 9 p.m. GMT. Sydney session opens by 9 p.m. GMT. Tokyo session opens by 11 p.m. GMT. London session opens by 7 a.m. GMT. Frankfurt session opens by 8 a.m. GMT. New York session opens by 1 p.m. GMT. Of course, we know that Nigeria is GMT plus 1. So Nigeria will fall, and we know that we use UK time. Okay, we use UK time, England. So our trading session is what? The London session. That is our own trading time, the London session. Okay, so of course Nigeria is GMT plus 1. Now let me point out that the forex market opens every Sunday by 11 p.m. here in Nigeria. Once it is 11 p.m., the forex market opens 11 p.m. And from the time here, you can see that the one that falls into that session is what? Tokyo session, because Tokyo session is what? 11 p.m. So this 11 p.m., the forex market opens. Markets begin to set up, but the movement of currencies is actually very, very slow because market is just about to start. Then we have the 11 p.m. After 11 p.m., the next one we have is 11 p.m. We have 7 a.m. because we have 11 p.m. We have 12 a.m. That is 12 midnight. We have 1 a.m., 2, 3, 4, 5, 6, 7 a.m. What is 7 a.m.? London session opens. Market begins to gain more momentum. Then 8 a.m. Frankfurt session, which is European session, opens. You see how it moves. Then by 1 p.m. in the afternoon, American session opens, which is 1 p.m. Every session lasts for what? 9 hours. Now, there are some terms we need to know. As a forex trader, there are certain terminologies, certain jargons you should know. So that when you are discussing with a trader, there are certain terms you guys can use. People who are around that are non-traders would not be able to comprehend what you're saying. Every discipline has jargons, has terminologies that are peculiar to it. All right. Now we have certain words, certain terms, certain terminologies that you should know as a trader. Some of these terms include bulls. In forex trading, once you hear bulls are what? Buyers. Bears are sellers. That means when you open your forex charts after your analysis and you click on buy, it means that you're a bull, you're buying. When you click on sell, it means that you're a bear, you're selling. Bull market is a market that is predominated by demand, that is trends upward. When the market is moving upward, such market is called a bull market. We have the bear market. When the market is moving downwards, such market is called the bear market. It means that there are more sellers in the market. More people are selling, so the market is falling, it's going down. We have the long order. Long order refers to buy order. So instead of people to say, I want to buy Euro USD, I can simply say, I want to go long on Euro USD. It's still the same thing. It still means I want to buy. So long order is buy order. Short order is for sell order. So somebody can simply say, I want to short USD card. What the person is trying to say is that he or she wants to sell USD card. Okay, USD card simply means United States dollar against Canadian dollar. You understand better when we get to currency pairs, right? We have what we call trending markets. A market that has a direction. It could be trending up or down. It's either moving upwards or downwards. So you can hear people say a market is trending upwards or the market is trending downwards. So when you hear trending market, the next question you ask is it trending upwards or trending downwards? If you say it is trending upwards, it means the market is what? Moving upward. The market is buying heavily. If you say it is trending downward, it means the market is what? Selling heavily. Ranging market. What do we mean by ranging market? When somebody says, I opened the chart after I discovered that the market is ranging, what is the person trying to say? Now, ranging, this is when price is moving within a channel. So you may hear people tell you that the market is just ranging. They are indirectly telling you that the market has not found any direction yet. That is the meaning of ranging. Okay? Ranging is the opposite of trending. For trending, it is either it is trending downwards or trending upwards, just as you can see in the diagram here. You can see trending downwards. You can see this other side trending upward, but in the middle we have the ranging. The ranging is the opposite of trending. Ranging means market is just moving within a channel. Within a channel, it has not found a direction yet. Market has not found a direction yet, so it moves up, it comes down within a channel. Now, what of consolidation? Consolidation, this is a choppy market movement. Consolidation occurs inside the range. It is a tighter range. What we mean is that consolidation simply means when market is just moving zigzag movement. There is no direction. You see choppy movement within a range, within a channel. Like from this diagram here, you can see there is a channel here. You can see inside this channel, you see the movement of the candles, the movement of the price. No clear movement, just choppy. This is what we call choppy market. Now, liquidity. Let's talk about liquidity. When you hear liquidity, what does it mean? As a forex trader, when you hear liquidity, what comes to your mind? Now, it's very simple. Liquidity is the volume of money present in the market at a given time. The volume of money present in the market at a given time, okay? That is what we mean by liquidity, the amount of money present. Now, certain things can influence this liquidity. For instance, during holidays, traders, go on recession. You see that the volume of money in the market decreases. The price movement is very, very slow because there is no money. When the holiday clears and traders come back to the market, they inject funds into the market. They inject liquidity into the market and see that the market begins to move at a considerable speed. Volatility, I just talked about considerable speed. That speed I talked about is volatility, right? Volatility, this refers to when the market is in a high motion. It normally occurs during news releases, okay? Volatility, in a very simple term, it talks about the speed of the market. How fast is the market moving? More liquidity in the market means high volatility, okay? Low liquidity in the market means what? Low volatility. And finally, we have what? Leverage. What is leverage? Leverage is otherwise known as debt. Most retail traders are undercapitalized, therefore cannot participate in the forex market. Now, when you want to open your account with a brokerage company, of course, as a trader, you must partner with a broker. A broker is a company that grants you access to the market, okay? They offer you the trading interface and other support you need to trade the market. Now, brokers offer us one important thing called leverage. Leverage is like debt, okay? They loan money to you to enable you to trade the market, because ordinarily, you cannot trade the forex market with your little $1,000, $2,000, $100. You cannot do that because the market is very, very volatile, okay? To just sweep that money. So what brokers do is that they give you loan to add to your money. Sometimes brokers can give you loan up to 1:500 or leverage up to 1:500. Some brokers even give you up to 1:2000. All right. So for instance, now let's say a broker gives you 1:500 leverage, which is also loan or debt. If you fund $100, what it means is that that $100 is going to behave like 100 times 500, because the broker has given you a leverage of 1:500. So when you deposit $100, that $100 will have the ability to behave like 100 times $500. Right? So that makes you to be able to trade the market. Of course, 100 times 500, that's about $50,000. Okay, that enables you to trade the market very effectively. That is what leverage is all about. Like the broker we use, HF Markets, which is one of the finest brokers in the world, they offer leverage up to 1:2000. But I don't like trading with that high leverage because it has its own side, its own, disadvantage, which I will discuss with you as we proceed. Okay, normally I trade with 1:400 leverage. That is what I use, 1:400 leverage. Spread. Let us talk about spread. What is spread? What is spread? Spread, this is the cost of completing a trade deal in the forex market. Each time you open a trade, your broker will charge you this fee. Spread is mathematically expressed as difference between the bid and ask price, right? What it means is that whenever you open a trade, there is a spread charge. Okay, before I explain spread, bid and ask price, we enable you to understand it better. Now, what is bid price? Bid price, this is the price at which a buyer is willing to offer for an asset at a particular time. What is ask price? This is the price. This is price which a seller is asking for his asset at a particular time. Let me explain it. When you walk into a shopping mall to buy something, the price tag on the item you want to buy is the ask. Is what? Ask price. That is the price the seller is willing to sell that item to you. All right. Now, when you look at the price tag on that item and you feel it's higher than what you've budgeted, and you offer your own price, that price that you have offered to buy that item is called the bid price. Okay. For instance, unless you want to buy a mobile phone, seller says this phone is 200,000 naira, and you tell the seller, I can buy this phone for 150,000. The 200,000 the seller has given to you is called the ask price. The 150,000 naira that you have offered is called the bid price. Now, the difference between this bid and ask price is what we call spread. That brings us to spread. So in this illustration that I have given to you, ask price, which is the selling price, is what? 200,000. Bid price, which is the buying price, what? 150,000. So the spread here is what? 200,000 minus 150,000, which brings it to what? 50,000 naira. So your spread here mathematically is ask price minus bid price. And this is how brokers make their money. This is how brokerage companies make their money. The moment you open a trade, okay, you are charged at a spread that is charged. all right? And then the trade then is conducted on the platform of the broker. Now, PEEP, what is PEEP? We hear PEEP in Forex. What does it mean? What does it stand for? PEEP, this is a unit change in price of a currency or asset. It is mostly expressed numerically as the fourth digit from the decimal point of a price quote. All right? Of course, the fraction of PEEP is known as pipette. Well, you don't need to bother yourself so much about this. Just know that PEEP is the unit change in price of a currency. Now, when you check your MT5, that gives you different quotes, different currencies. You see that there are two prices attached to every currency pair. In your MT5, when you check it, there are two prices attached to your what? Your MT5. You will see two prices. One price there represents the bid price. The other price represents the ask price. The unit, the slightest change in the price of any currency is what they call the PEEP. It's very little, very negligible. That slight change is what they call the PEEP. Forex broker. Who is a forex broker? A forex broker is a financial services firm or agent that enables traders and investors to trade global currency pairs via a forex trading platform. I just explained it. Forex brokers are companies that allows you to trade the forex market. Okay, brokers act as intermediaries or middlemen. Forex brokers connect retail traders with the forex interbank markets, and they earn commissions for doing that. Commissions earned by forex brokers are called spreads. Like I said, commissions earned by forex brokers are called what? Spreads. They are called spreads. These are examples of brokers. Examples of broker. We have so many of them. But not all of them are good to do business with. Some of them manipulate trade. Okay. Some of them we have two types of brokerage orders. We have what they call A list and B list. You understand? We have A list. We have the B list. Okay. You know, some forex brokers they B book list. Some forex brokers they A book list. What it means is that for forex brokers that A book list, what it means that whenever you place an order, they take your order directly to the market. Okay, you are interacting directly with the global market. That is A book listing. Some brokers do what they call B book listing. When you place a trade, they hold the trade on their system. They hold the trade. Okay, then if the trade pays, they pay you. If the trade loses, in fact, they just hold the trade. They interfere with your trade in a very simple thing. They interfere with your trade. They do not take your order directly into the market. They always hold your trade. You might think that your order is interacting with the market, but no, they are holding your order, manipulating trades and all of that. Okay, that is why not every broker you do business with, and some of the brokers, their spreads are very high, very high spreads. Okay, when you place an order, before that order can start giving you profit, the spread must be covered. And when the spread is too high, it sucks your profit. Spread sucks your profit. You know, it drains your profit. You would have to wait for the order to cover up their spread before you can start seeing profit. Whereas good brokers, their spreads are very minimal. Like HF Market offers us even zero spread. You know, the moment you place your trade starts running, you know, accordingly. So we have so many brokers. We have Delta Stock, Direct FX, Lucas Copy, Triple FX, Alpari, Excel, a lot of them. FX Open, of course, you can see Hot Forex. This Hot Forex here is HF Market. All right. When they started, they were called Hot Forex, but as they rebranded, you know, they became HF Market. They are 15 years old in the market currently. HF Market is 15 years old. Very old, and then very amazing. Wonderful broker. Very wonderful broker. So we have so many brokerage companies, a whole lot of them. Now let's talk about hawkish, dovish, NFP. Hawkish, dovish, NFP. This term is mostly used when referring to the central bank governor or personnel of a country. When they are hawkish, they tend to be liberal on interest rates and are willing to increase it. This is good news for investors. Now let me just explain this with simple terms. Hawkish simply means that the central bank governors are liberal with interest rates. At every point, they are increasing interest rate. And of course, you know what that does to investors? When interest rate is increased, it attracts investors into the system. So investors are able to, to pump in money, all right, to put in their money, because higher interest means they can make more money from their deposit, from their investment, and all of that. But the opposite of hawkish governors is what we call dovish governors. Dovish governors are the ones that they always restrict interest rates. At every point in time, they are looking for ways to tighten up interest rate, to reduce interest rate. And of course, you know what that does? When interest rate is reduced, investors will begin to what? Put out their funds. Nobody would want to put his money in a place where it's not yielding meaningful interest. So hawkish are liberal, increase interest rate. Dovish are restrictive, they reduce interest rate. And we have what we call the NFP. NFP is an acronym for non-farm payroll. Okay, and it's a very important news event in the US. Now, every first Friday of every month, there is a major news released. That news is called NFP, non-farm payroll. It's a very, very major. In fact, it's the biggest news in the forex, forex trading market. So every trader is always looking out for that NFP. Okay, so we'll end here. Our next discussion will take it from forex market analysis.